everyone, this is Ayushi Verma from Investor Learn Academy and I welcome you all to this channel. In the last video, we understood the concept of balance sheet of a company and its components. Today we will talk about one of the most important ratios, that is profitability ratios, in detail. The financial statements gives us an insight about the company's financial data, and to check the company's ranking with its peers, the financial ratios plays an important role. The theory of the financial ratios was made popular by the Benjamin Graham, who is popularly known as the fundamental analysis father. Financial ratios help interpret the results and compare the previous years and other companies in the same industry. Now let's assume that TCS has a profit margin of 15%. Now do you think this information is useful? Not much actually. 15% profit margin is good, but how would I know if this is the best? Now assume you figure out that Infosys profit margin is 12%. Now if we compare these two similar companies, comparing the profitability makes sense. Financial ratios utilize data from the financial statements to compute its value. Financial ratios can be classified into different categories like profitability ratios, leverage ratios, valuation ratios, and operating ratios. Today in this video, we'll talk about the profitability ratios, and the rest of the ratios we will be discussing in the upcoming videos. Now let's start with it. Profitability ratios are the financial ratios that talk about the profitability of the business with respect to its sales or investments. Since the ratios measure the efficiency of the operations of the business with the help of the profits, they are called profitability ratios. The profitability ratio of a company also signals the competitiveness of the management. As the profits are needed for the business expansion and to pay dividends to its shareholders, a company's profitability is an important consideration. The purpose of calculating the profitability ratio is to measure the operating efficiency of the business and the returns which the business generates. The different stakeholders includes the owners, management, creditors, lenders, etc. of a business are interested in the profitability ratios for different purposes. So there are different types of profitability ratios, and these are as follows: gross profit ratio, operating profit ratio and EBITDA margin, net profit ratio, return on capital employed, return on equity, return on assets, return on net worth, earnings per share, book value per share, dividend payout ratio, and price earning ratio. Now let's start understanding each one of these in detail. First, gross profit ratio. Gross profit ratio is the profitability ratio that measures the relationship between the gross profit and the net sales revenue. When it is expressed as a percentage, it is known as the gross profit margin. It is known by different names like gross profit ratio or gross margin. The formula for the same is net sales minus cost of goods sold divided by net sales. The ratio indicates the percentage of each rupee of revenue that the company retains as gross profit. For example, if the ratio is calculated to be 20%, that means for every rupee of revenue generated, 20% is retained, and while 80% is attributed to the cost of the goods sold. If a company's gross profit margin widely fluctuates, this may signal poor management practices or inferior products. On the other hand, such fluctuations may be justified in cases where a company makes operational changes to its business model. In this case, the temporary volatility can be seen, and this is not much of concern. Higher gross profit margin is a good sign for the business. The higher gross profit margin may be a reason for the efficient management, low cost production, and increase in the sales price, or over or undervaluation of stocks. Lower profit margin ratio is a sign for the bad business, and that could be a reason for the higher cost of production, the decline in the sales, and lot other things. The following are some of the uses of gross profit margin. First, the lenders use this to check the credibility of the business. Second, the management can find out their efficiencies or inefficiencies so that they can improve upon the inefficient areas and capitalize on the efficient one. Third, the owners will have an idea about the returns they are going to receive on their capital. The second is operating profit ratio and EBITDA margin. Operating margin and EBITDA, which is also known as earnings before interest, taxes, depreciation, and amortization, these are the two measures of a company's profitability. The two ratios are related but provide different insights about the financial health of the company. A company's operating profit margin ratio tells how well the company's operations contribute to its profitability. It's a type of the profitability ratio that is used for determining the operating profit and net revenue generated from its operations. The operating profit is the profit of the company after paying the different variable cost of productions like raw material purchase, wages, labor cost, etc. The operating ratio displays the efficiency of an organization in controlling its cost, and the formula for calculating the OPM is as follows. So you can divide the operating income with the total revenue, or other ways you can divide the earnings before interest and taxes, which is EBIT, divided with the total revenue. Now let's take an example and suppose the sale of the ABC Limited is 2 crores rupees. The operating cost is 33 lakhs and the cost of goods sold is 75 lakhs. Now if we calculate with the above formula, we are getting a figure of 46%. Now from the calculation, it can be concluded that 46% the company earns this much percentage before taxes and interest for every rupee of its sales value. Higher operating margin ratio is beneficial for the organization. It signifies that more proportion of the revenue of the company is converted into operating income. The second part is the significance of operating margin ratio. Some of the points are as follows. First, a company with higher operating margin ratio is financially sound. It can easily pay its fixed cost and interest on the debt. Second, a company with good operating ratio can successfully survive during the economic crisis. Third, only a company with higher operating margin ratio can successfully compete with its competitors by lowering down the prices of its products to such level that the competitors will not able to survive. The second part is EBITDA, or earnings before interest, taxes and depreciation and amortization, which is slightly different from its operating profit. An EBITDA margin allows the investors to understand the operational profitability as well as the cash flow of the company. It can be used to evaluate a range of companies regardless of their size, structure, tax obligations or depreciation. An EBITDA margin is used to determine the efficiency and performance of the company along with its earning potential without focusing on aspects like taxes or debt financing. The formula for calculating the EBITDA margin is as follows, where we can see the EBITDA can be divided with the total revenue into 100. For example, if a company ABC shows an annual revenue of, let's say, 10 lakhs of rupees and EBITDA is 1 lakh, then EBITDA margin can be 10. The higher EBITDA margin, the more operationally efficient the company is perceived to be. Some of the industries like telecommunication, oil, railroads, tobacco, alcohol and banking, whose companies have the highest EBITDA margins. While EBITDA margin is a helpful indicator to determine the financial health of the company, it can be misleading in some of the cases where the company is having higher significant debts. Such debt needs to be taken into account before concluding the financial health of the company. Now let's see the difference between the EBITDA margin and operating margin. While both are highly popular metrics to determine the profitability of the company, the EBITDA and the operating margin differ in significant ways, which includes the following points. First, EBITDA is used to determine the total potential earnings of the company, whereas the operating margin aims to identify how much profit the company can generate through its operations. Second, under EBITDA, adjustment can be made in amortization and depreciation, whereas in the operating margin, it can't be done. Third, EBITDA is not a measure under the generally accepted accounting principles, which is GAAP, which means it is not used for financial reporting, whereas the operating margin is officially under GAAP. Third, net profit ratio. Net profit ratio is an important profitability ratio that shows the relationship between the net sales and the net profit after tax. It is the most common profitability ratio which is used to measure the profit after deducting all the expenses, losses and provisions for the bad debt. For example, if you have a net profit margin of 10%, then on every 1 rupee that you have invested in the business, you earn 10 paisa. Net profit margin shows the margin left for the equity and the preference shareholders. Unlike the gross profit margin, which measures only the operating efficiency of the business, the net profit margin measures overall efficiency of the business. An adequate margin of the net profit will be generated only when most of the activities like production, administration, selling, financing, pricing, tax management or inventory management are being done efficiently. The formula for the net profit margin is as follows. So you can see that the net profit can be divided with the net sales. The net profit can be seen in terms of the profit before interest and taxes and profit after interest and taxes. PBIT is particularly useful when the purpose of calculating net profit margin is to assess the operating efficiency of the business. With this profit, the ratio can be comparable to the industry and the competitors. The PAT is the profit after taxes. The fourth ratio is the return on capital employed. The return on capital employed is a profitability ratio that measures how well a company is able to generate profits from its capital, which includes both debt as well as equity. Return on capital ratio formula can be seen as follows, where we can see the net operating income or EBIT divided by capital employed. Now let's say a company ABC has net operating income of rupees 3 lakhs and out of that 2 lakhs is assets and 50,000 is liabilities. To calculate ABC's ROCE, you would like to divide the net income by its assets minus liabilities. This would give you a rupees 2 figure, which means that for every 1 rupee invested in capital employed, the ABC earns rupees 2. A higher EBIT compared to the total capital employed would result in a higher return on capital employed ratio, which means that the total assets or the capital employed in the business operations generate higher returns for the company. This indicates a good financial health. ROCE is a majorly useful ratio comparing capital intensive businesses that require a bigger amount of heavy capital in its business operations. Such companies include car manufacturing units, airlines, railways, steel manufacturers, etc. These companies have massive investments in their capital and hence efficient use of this capital can prove to be a healthy investment opportunity for any potential investor. The fifth ratio is return on equity. Return on equity measures the entity's ability to generate profits from the shareholders' investment. In other words, ROE shows the efficiency of the company in terms of generating profits to its shareholders. The formula of calculating ROE is profit after tax divided by net worth, where the net worth equals to equity share capital and reserves and surplus. The higher the ROE, the better it is for the shareholders. If the ROE is high, it means a good amount of cash is being generated by the company and hence the need for the external funds is less. Thus, a higher ROE indicates a higher level of management performance. Sometimes the ROE can be a misleading figure. ROE can increase with a reduction in shareholders' equity. If ROE increases due to a drop in equity, which ultimately results in an increase in the debt company takes, it will expose the company to a greater risk. For example, a company may issue buyback of its shares, which may increase ROE. Thus, investors need to exercise caution while using ROE ratio. In this case of buyback or issue of new shares, it is best to evaluate ROE along with EPS, which can give you a clearer picture of the earnings from equity. The sixth ratio is the return on assets. Return on assets evaluates the effectiveness of the entity's ability to use the assets to create profits. The formula for ROA is very simple and can be seen as follows, where we can see that the profit after taxes divided by total assets. Higher is this figure, better is the utilization of the company's assets. For example, a company may earn profits worth rupees 1 million with an investment of 10 million, giving ROA of 10%. On the other hand, another company can give the same profit with an investment of just 5 million, giving ROA of 20%. The second company is utilizing its resources better because although both are generating the same profits, the second company is doing it with half the investments. It's easier to generate profits if you pump in the huge amount of money. But one needs to understand, one needs to consider the cost of capital and the opportunity cost as well with every investment being made. Lower productivity of the assets or wastages are the key reasons for lower ROAs. Lower productivity of the assets can be cured by proper repair and maintenance or replacement of the old assets. Wastages not only means the product or the raw material wastage, the wider meaning of wastage includes idle labor hours, etc. Proper production planning and process of the testing the products at every stage can significantly reduce the wastages. Seventh ratio is the return on net worth. This is also known as the return on shareholders' funds and is used for determining whether the investment done by the shareholders are able to generate profitable returns or not. It should always be higher than the return on investment, which otherwise would indicate that the company funds are not utilized properly. The formula for calculating the return on net worth is as follows, where we can see that the profit after taxes divided by the shareholders' funds into 100. The next ratio is earning per share, which is also known as EPS. That is a profitability ratio that measures the extent to which a company earns profit. It is calculated by dividing the net profit earned by the outstanding shares, and the formula for calculating the EPS says that the net profit divided by total number of shares outstanding. Higher EPS means more profitability for the company. Ninth ratio is book value per share. Book value per share is referred to as the equity that is available to the common shareholders divided by the number of outstanding shares. The equity can be calculated as follows, where we can see that the shareholders' funds minus preference share capital, and the formula for calculating the book value per share is as follows, where the shareholders' equity minus preferred equity divided by the total outstanding common shares. 10th is the ratio of dividend payout ratio. Dividend payout ratio calculates the amount paid to the shareholders as dividend in relation to the amount of net income generated by the business. It can be calculated as follows, where we can see that the dividend per share divided by the EPS. 11th is the ratio which is known as price earning ratio. This is also known as the PE ratio. It establishes a relationship between the share price of the company and the earning per share. It is very helpful for investors as they will be more interested in knowing the profitability of the company and how much profitable the company will be in the future. Price to earning ratio is calculated as follows, where we can see the market value per share divided by the EPS. It shows if the company's stock is overvalued or undervalued. I hope the concept of profitability ratios is clear to you by now. We'll meet you on next Monday with a new topic. So till then, be safe and happy learning.